Imagine you negotiate £1,000 pay rise. Your payslip arrives. You take home less than £600 of it. That is not an error. It is exactly how the UK tax system works at certain income levels, and once you see the maths, you will never look at a pay rise the same way again. Yesterday we looked at how pension tax relief turns an £800 contribution into £1,000 inside your SIPP. Today, 3 things that explain what happens to your pay above the £50,270 threshold. First, how income tax and national insurance interact at exactly that point, and what your real marginal rate is. Second, how the high-income child benefit charge can push that effective rate well above 40% for families earning between £60,000 and £80,000. And third, why frozen thresholds mean 2.6 million more workers are expected to cross into higher rate territory by 2027 to 2028, with no rate change required. Let us start with what the threshold actually is. In England, Wales, and Northern Ireland, you pay 20% income tax on earnings between £12,570 and £50,270. Cross that upper line and the rate on each additional pound jumps to 40%. That is a 20 percentage point increase in one step. Most people stop there and assume their marginal rate is now 40%. But there is a second thing happening at exactly the same moment. National insurance for employees runs at 8% on earnings between £12,570 and £50,270. Above £50,270, that rate drops to 2%. So at the exact moment your income tax rate rises by 20 points, your national insurance rate falls by 6 points. The combined marginal rate on a pound earned just above the threshold is 40% income tax plus 2% NI, giving you 42% going to deductions, not 48%. Below the threshold it was 20% plus 8%, so 28%. The jump is real, but slightly smaller than most people assume. Now apply that to your £1,000 raise. On £1,000 of gross pay above the threshold, £400 goes in income tax, £20 in national insurance. You keep £580. That is where the number in the title comes from. It is not a rounding error or a quirk. It is the maths of 2 rates moving in opposite directions at the same point, with income tax winning the argument comfortably. Now here is the part that surprises people who have children. Meet Dan. He is 36, earns £61,000, and has 2 kids. His family claims child benefit. For 2024 to 2025, that is £25.60 a week for the first child and £16.95 a week for the second. Over a year, that adds up to £2,212.60. For most of his neighbors, that money just arrives. For Dan, it is being quietly clawed back. The high-income child benefit charge works like this. If your adjusted net income, the figure HMRC uses, sits below £60,000, you keep every penny of child benefit. Above £80,000, it is completely gone. In between, for every £200 of income above £60,000, you lose 1% of your total child benefit. So across that £20,000 band, the benefit tapers away in 100 equal steps of 1% each. Dan at £61,000 has already lost 5% of £2,212.60, which is roughly £110 of annual benefit, just from earning £1,000 over the threshold. Here is where it bites hardest. For each extra pound Dan earns between £60,000 and £80,000, he pays 40% income tax plus 2% NI, so 42 pence gone already. But each extra pound also accelerates the child benefit taper. Over that £20,000 band, a 2-child family loses £2,212.60 in total, which works out to roughly 11 pence of benefit lost per pound of gross income. Add that to the 42 pence in tax and NI, and the effective marginal rate in that band sits around 53%. Dan keeps roughly 47 pence of each pound he earns in this range. To make this concrete, compare 2 identical families. One earns £59,000 and keeps the full £2,212.60 in child benefit. The other earns £61,000 and has already begun losing it. The higher earner, after tax and the clawback, may actually have less disposable income than the lower earner depending on their other costs. That is not a mistake in the system. It is a known consequence of a tapered benefit meeting a steeply progressive tax, and it is the reason financial educators flag this ban specifically. Now for the third mechanism, and this one affects far more people than child benefit does. The personal allowance is frozen at £12,570. The higher rate threshold is frozen at £50,270. Both stay there until April 2028. That sounds neutral. It is not. When wages grow and thresholds do not move, workers are carried across the higher rate line by pay rises alone. No politician has to announce a rate change. No headline says tax rise. It just happens quietly, year after year. With average regular pay in the UK growing at roughly 5.9% in the year to October 2024, according to ONS data, a worker earning £45,000 today could cross £50,270 faster than they might expect. The Office for Budget Responsibility estimated this freeze will pull an extra 2.6 million people into the higher rate by 2027 to 2028, on top of those already there. That is not 2.6 million high earners. Many of them are teachers, nurses, and experienced tradespeople whose salaries have simply kept pace with inflation. Here is the counterintuitive part. Nobody changed the rate. Nobody changed the threshold. And yet the tax take goes up because the economy did what economies do, which is grow. This mechanism has a name, fiscal drag, sometimes called bracket creep. It is one of the most effective ways a government can raise revenue without a budget announcement, because each individual worker simply experiences it as a slightly smaller pay rise than they expected. Everything we have covered so far is educational context, not advice. What this section does is show the mechanical logic of one widely available option, so you understand how it works. The key number HMRC uses for both the higher rate threshold and the high income child benefit charge is adjusted net income. This is your gross income minus pension contributions made outside salary sacrifice, and minus certain other deductions. If you can reduce that number, multiple things change at once. Back to Dan. He earns £61,000. If he contributes £1,000 to a pension this tax year, his adjusted net income drops to £60,000, sitting at exactly the HICBC threshold. The clawback stops. He keeps the full £2,212.60 in child benefit. He also gets higher rate income tax relief on that £1,000 contribution, meaning the real cost to him is around £600 out of pocket, because £400 of the contribution comes back via tax relief. The pension contribution restores £2,212.60 of benefit and costs roughly £600 net. The maths here is not advice. It is arithmetic. For viewers outside the UK, the underlying principle translates directly. In the US, a pre-tax contribution to a 401k reduces your adjusted gross income, which can affect eligibility for certain credits and deductions in a similar way. In Canada, an RRSP deduction reduces net income, which feeds into benefit clawbacks like the old age security repayment threshold. The specific wrappers are different, but the core logic, that pre-tax pension contributions reduce the income figure the tax authority uses for multiple calculations, is consistent across all three systems. Let us bring this together into one picture. For a standard employee in England with no children, the marginal rate above £50,270 is 42%, 40 income tax, to an eye. For a parent of two children earning between £60,000 and £80,000, add roughly 11 percentage points of effective HICBC drag, and you are looking at around 53%. For a parent earning near the top of that band, the effective marginal rate may be even higher depending on their exact child benefit entitlement. None of this means avoid the raise. Higher lifetime income is still higher lifetime income. It means know your number before you sit down to negotiate, and plan accordingly. Quick recap of the three things we covered. 1. Above £50,270, income tax rises 20 points to 40%, but NI falls 6 points to 2%, so the combined marginal rate on that slice is 42%, not 48%. 2. The high-income child benefit charge adds a further effective layer between £60,000 and £80,000, clawing back up to £2,212.60 a year for a two-child family across that band. 3. Frozen thresholds mean fiscal drag is moving an estimated 2.6 million more workers into higher rate territory by 2027 to 2028, with no rate change required. If this helped, the most useful next step is to look up your own adjusted net income figure, which you can find through your HMRC personal tax account, and check whether you sit near any of the thresholds we have covered today. Understanding your position does not require an accountant. It requires a number and a bit of arithmetic. Tomorrow we look at another money decision worth getting right, so subscribe and I will see you then. A quick reminder, this is educational content only, not financial, tax, or legal advice. Speak to a licensed professional in your jurisdiction before making any decisions. In the UK, look for an FCA authorized advisor.